Hi everyone, welcome to my YouTube channel. This channel is dedicated to helping you master mathematical problems relating to actuarial concepts in a simple and practical way. Whether you are preparing for exams, building a career in actuarial science, or just love maths, you are in the right place. So let's get started. Right, so once again we are looking into the theory of interest chapter 1. We looked into cash flow model in the previous video, but in this we shall be looking into the time value of money interest rate. Alright, now time value of money interest rate is what we are considering in this video. Now, we all know that the important role played by interest rates in the aspect of the time value of money cannot be overemphasized, as it is a simple concept that we can relate to it in our financial sector. So, interest may be regarded as a reward paid by one person or organization known as the borrower for the use of an asset referred to as the capital belonging to another person or organization known as the lender. So, when the capital and interest are expressed in monetary terms, capital is also referred to as principal, and the amount received by the lender after a period of time is called the accumulated value. Also, the difference between the principal and the accumulated value is called the interest, that is, I is equals to A minus P. The factors that determine the rate of interest includes inflation rates, as lenders demand higher interest rates when inflation is high to maintain their purchasing power. We also have central bank policy, where the central bank, for example the Federal Reserve, sets benchmark interest rates that influence lending and borrowing rates across the economy. We also have the demand and supply of money, as higher demand for credits like loans increase interest rates, while excess supply of money lowers interest rates. We also have credit risks, in which borrowers with a higher risk of default are charged higher interest rates to compensate for the risks. We have also term of loan, as this is talking about the duration of the loan, as long-term loans have higher interest rates due to greater uncertainty and risks. We have also global economic conditions. When the global economy is strong, countries may experience interest rates, investments, and capital movement. These are a few factors out of the many determinants of the rate of interest. So out of the time value of money interest rate, we shall be looking into the following: the meaning of interest, simple interest, and compound interest. Now, looking into the meaning of interest, what is interest? Interest is a measure of growth of money over time, often expressed as a rate and used to determine the accumulation or discounting of cash flows. The difference between the principal and the accumulated value is called the interest, that is, I is equals to A minus P. We shall have many formulas to be memorized under this course, the theory of interest, among which I is equals to A minus P stands as 1. There are two types of interest, which includes simple interest and compound interest. What then is simple interest? Simple interest is a type of interest once credited to an account does not earn further interest. It is simply the type of interest where the interest rate is accrued only on the principal amount. Let's take for example a principal of $10,000 given at a rate of 10% and an amount value to be total at the end of the year. For year 1, with a principal of $10,000, we have $1,000 as the rate of interest from the principal and a total amount of $11,000 at the end of year 1. For year 2, we have $11,000 at the beginning of the year with an interest of $1,000 from the principal, leaving the total amount to $12,000 at the end of year 2, and year 3, $12,000 at the beginning with an interest of $1,000 from the principal, leading to a total of $13,000 at the end of year 3. From the illustration, $10,000 represents the present value, while $13,000 represents the future value. Under the simple interest, we can calculate the present value and the future value using a formula. The future value is calculated as FV is equals to PV parenthesis 1 plus IN, where we take this as our second formula, while the present value is calculated as PV is equals to FV parenthesis 1 plus IN raised to the power of minus 1, arrive at just by making PV the subject of the formula, where we take this as our number 3 formula, where the FV is equals to future value, PV is equals to present value, I is equals to interest rate, and N is equals to the numbers of years. Now, let's take some example. Question 1. An investor deposited $10,000 in a bank account that pays simple interest at a rate of 10% per annum. What will the deposit accumulate to after 3 years? Now, to solve this, we need to find out if number 1, it's simple interest or compound interest, and number 2, if it's accumulating or discounting. And from this question, it is stated that we are to accumulate and also stated that it is simple interest. Now to solve, since we are accumulating, we use the future value of simple interest, which is FV is equals to PV parenthesis 1 plus IN, where FV is unknown. PV is equals to $10,000, I is equals to 10%, and it is ideal to always express your percentage in decimal form, that is 10% is equals to 0.1 and N is equals to 3 years. Now to calculate the future value, knowing that FV is equals to PV parenthesis 1 plus IN and PV is substituted to be $10,000, 1 plus 0.1 times 3 in the parentheses. Now $10,000. Now to solve this, we are going to start with what we have in the parentheses. So 1 plus 0.1 times 3 becomes what? 1 plus 0.3, where 0.1 times 3 becomes 0.3. And when we add 0.3 to 1, we get 1.3, which makes it what? $10,000 multiplied by 1.3, and that will give us a total balance of $13,000 for the future value. Hence, the deposit will accumulate to $13,000 after 3 years. Therefore, the future value is equals to $13,000. For question 2, given a payment of $2,000 due in 4 years' time, calculate the present value using simple interest of 3% per annum. Now to solve this, evaluating the question, we are asked to find the present value, which is also stated to be simple interest. And to find the PV of simple interest, PV is equals to FV parenthesis 1 plus I n raised to the power of minus 1, where PV is unknown, FV is given to be $2,000, I is equals to 3%, which is expressed decimally as 0.03, and n is equals to 4 years. Now substituting the value into the formula, we have PV is equals to FV parenthesis 1 plus I n raised to the power of minus 1. Now solving this, we have FV to be $2,000, then in the parentheses we have 1 plus 0.03 by 4 raised to the power of minus 1. Then moving on, we have $2,000 multiplied, and in the parentheses evaluating 0.03 by 4, we arrive at 0.12. Then 1 plus 0.12 will give us 1.12. Then finally, we have $2,000 multiplied by 1.12 raised to the power of minus 1. When you punch that in your calculator, you would arrive at $1,785.71 by approximating to 2 decimal places. Hence, the present value is $1,785.71. Therefore, PV is equals to $1,785.71. Now on to question 3. A bank lent an individual $1,000. The individual has to pay back $1,200 in 1 year's time. What is the interest? To solve this, from the question, the present value of $1,000 is given and the future value is given to be $1,200. To calculate the interest, we can use I is equals to A minus P, otherwise known as I is equals to FV minus PV. Hence, we update our formula where A, that is the amount, is known as the future value, and P, that is the principal, is known as the present value. Now to find I, PV is equals to $1,000, FV is equals to $1,200, and the formula I is equals to FV minus PV can be used to solve this, which is equals to $1,200 minus $1,000, which will give us $200. Hence, the interest is $200. That is, the I that we are looking for is $200. Now, moving on to compound interest. What is compound interest? Compound interest is a type of interest where the interest itself earns interest. It is a type of interest where interest is earned not just on the original principal but also on the accumulated interest. Just like the example we used under simple interest, let's assume we have a principal of $10,000 and a rate of 10% per annum accumulated for 3 years using compound interest. For year 1, the interest of 10% on the principal still yield $1,000, leaving the total amount to $11,000, which is the same as simple interest, which is to tell you that simple interest and compound interest functions the same in its first year, but at the second year, with the amount of $11,000 at the beginning, the 10% is calculated on both the principal and amount, giving us $1,000 plus $100, which gives a total of $1,100, and the amount at the end of year 2 as $12,100. At the beginning of year 3, we have the amount of $12,100 where interest accumulated from the principal of $10,000 and the interest of $1,000 and $1,100 results in an additional interest of $1,000 plus $100 plus $110, which totals to $1,210, resulting in a total amount of $13,310 at the end of the year, where $10,000 is the present value and $13,310 is the future value. Just like simple interest, we have formulas for calculating the present value and the future value of compound interest. The future value is calculated as FV is equals to PV parenthesis 1 plus I raised to the power of n, which will be taken as the fourth formula in our collection, while the present value is calculated as PV is equals to FV parenthesis 1 plus I raised to the power of minus n. Let's note that the difference between the two formulas is the negative symbol in the PV, where FV is equals to future value, PV is equals to present value, I is equals to interest, and N is equals to the numbers of years. Now, looking into some questions. Question 4. An investor deposited $10,000 in a bank account that pays compound interest at a rate of 10% per annum. What will the deposit accumulate to after 3 years? Just as we did earlier, to solve this question, we must identify if it's either simple or compound, and also whether it is accumulating or discounting. And from the question, we can see that we are accumulating. Hence, to accumulate, we will use the future value of compound interest, which is FV is equals to PV parenthesis 1 plus I raised to the power of n, where FV is what we are looking for, PV is equals to $10,000, I is equals to 10%, which is expressed decimally as 0.1, and n is equals to 3 years. Now to solve, FV is equals to PV parenthesis 1 plus I raised to the power of n. All we need to do is to substitute everything we have into the formulas. Now PV is $10,000, and in the parentheses we have 1 plus 0.1 raised to the power of 3. Now from within the parentheses we evaluate and get 1 plus 0.1 to become 1.1, and $10,000 multiplied by 1.1 raised to the power of 3 will give us $13,310. Hence, the deposit will accumulate to $13,310 after 3 years. Therefore, the answer is $13,310 as the future value of this compound interest. Now to question 5. Given a payment of $2,000 due in 4 years' time, we have to calculate the present value using compound interest of 3% per annum. Now to solve this, it is clear from the question that we are to use compound interest to solve this. But note that in questions where it is not stated if the interest is simple or compound, we will use compound interest, as it is compulsory to state that the interest is simple in order for us to use simple interest. Now to solve this question, we have to find the present value of compound interest using the formula PV is equals to FV parenthesis 1 plus I raised to the power of minus n. Now where PV is unknown, that's what we are looking for, and FV is equals to $2,000, I is equals to 3%, which is expressed decimally as 0.03, and n is equals to 4 years. So substituting this into the formula, PV is equals to FV parenthesis 1 plus I raised to the power of minus n, we have $2,000 in the parenthesis 1 plus 0.03 raised to the power of minus 4. Evaluating what we have here, we have $2,000, and in the parenthesis 1.03 from the addition of 1 plus 0.03 all raised to the power of minus 4. Now using the calculator, we punch 2,000 times 1.03 raised to the power of minus 4, and that will give us 1,776.97 approximated to 2 decimal places. Hence the present value is $1,776.96. Therefore the PV is equals to $1,776.97. We have come to the end of this lesson. Practicing more is the best way to get acclimated to mastering the concept with formula involving interest rates. Please don't forget to like, comment, share, and most importantly, subscribe. Up next is time value of money discount rate. Stay connected.